A man watched his entire retirement account lose $180,000 in 3 weeks. Every morning looked worse than the last. The news screamed, markets in panic, recession fears grow, investors running for the exits. He sat frozen in front of his laptop watching red numbers flood the screen. Then he made the decision that destroyed millions of investors before him. He sold everything. 2 months later, the market rebounded violently upward. And the terrifying part? He never recovered financially. Because market crashes do not destroy most people, panic does. If you are watching this while the market feels terrifying, comment the word "hold" below. Because what you are about to hear could save you from making the exact mistakes that quietly make ordinary investors poor during every major crash in history. The first thing you need to understand is this. Every crash feels like the end of the world while it is happening. Always. In 2008, people believed the financial system would collapse. In 2020, people believed the global economy might shut down permanently. Now investors are again terrified about inflation, war, AI bubbles, debt, interest rates, and market volatility. And honestly, some fears are real. Major banks and analysts are warning that markets remain vulnerable to inflation shocks, geopolitical conflict, and overvalued tech stocks. But here is what most people never realize. The biggest threat during a market crash is usually not the market itself. It is investor behavior. Research consistently shows that fear and herd psychology amplify crashes because people begin making emotional decisions instead of rational ones. And that leads to the first mistake that destroys wealth: panic selling at the bottom. This is the classic mistake. The market falls. Fear spreads. People imagine losing everything. So they sell. It feels safe emotionally. But financially, it is often catastrophic. One Reddit investor admitted he panic sold near the exact bottom of a decline, believing the market would keep falling. Instead, the rebound started almost immediately, and he spent months trying to recover. This happens constantly because human beings are wired for survival, not investing. Your brain treats financial loss like physical danger. When markets crash, your nervous system screams, "Get out now." But historically, panic selling locks in losses permanently. One investing community post explained it perfectly. Until you sell, your losses are only on paper. That sentence may sound simple, but it separates wealthy investors from emotional investors. Because market crashes eventually end. The investors who survive are usually the ones who stayed rational while everyone else panicked. And here is the uncomfortable truth. Most people do not sell because they studied fundamentals. They sell because they cannot emotionally tolerate uncertainty. That is why fear destroys more wealth than recessions. But what happens next is even worse. After selling, investors wait for the perfect moment to re-enter, and they miss the recovery. Studies repeatedly show that missing only a handful of the market's best recovery days can dramatically reduce long-term returns, and those biggest rebound days often happen during periods of maximum fear. That is why panic selling is so dangerous. The market punishes emotional timing, and this leads directly to mistake number 2, trying to time the crash. During every market decline, millions of people suddenly believe they can outsmart the system. They think, "I'll sell now, then buy back lower." Sounds smart. Almost nobody succeeds. Even professional investors struggle to consistently time markets correctly. One Reddit discussion during recent volatility warned that panic selling during geopolitical fear often leads people to sell near temporary bottoms, while rebounds happen unexpectedly fast. Because markets move emotionally, not logically. And modern markets are even more dangerous because algorithmic trading, options positioning, and institutional hedging amplify both crashes and rebounds. Translation? The market can violently reverse upward before ordinary investors even process what happened. That is why many people sell during fear, then buy back higher later. The exact opposite of successful investing. One market strategist recently warned that investor positioning has become dangerously crowded and unstable, meaning corrections could become extremely sharp and unpredictable. And that unpredictability destroys market timers. Because nobody rings a bell at the bottom. Nobody announces, "Okay everyone, panic is over now." The recovery often starts while headlines still sound terrifying. That is what makes crashes psychologically brutal. The market recovers before people emotionally feel safe again. And honestly, this is where ordinary investors quietly lose decades of wealth. Not because they lacked intelligence, but because they lacked emotional discipline. That decision alone has already financially ruined millions of people. But the third mistake is even more dangerous: owning the wrong assets entirely. During easy bull markets, almost everyone feels smart. Speculative stocks explode upward, crypto surges, risky tech companies soar. People believe this time is different. Then crashes expose reality. One of the biggest risks right now is concentrated exposure to overvalued sectors and speculative assets. Analysts are increasingly warning about narrow market leadership and crowded positioning in technology stocks. This becomes deadly during corrections, because weak assets collapse first. Many investors think diversification is boring until crashes arrive. Then suddenly everyone wishes they owned safer assets. One investing discussion warned that many people believe 100% stock exposure is safe simply because markets have gone up for years. But crashes eventually remind investors what real risk feels like. And this is where wealthy investors think differently. Instead of chasing excitement, they build protection. So what should investors buy instead during volatile markets? Not hype, not panic trades, not get-rich-quick assets. Historically, resilient investors focus on four things. This is boring advice. And boring advice usually works best. Broad index funds reduce the risk of individual company collapse while allowing investors to benefit from long-term economic growth. Instead of betting everything on one hot stock, you own hundreds or thousands of companies. This reduces catastrophic risk. And historically, markets eventually recover because economies continue adapting and growing over time. The key word is eventually, because emotionally weak investors often quit before recovery arrives. Cash is underrated during crashes, not because cash creates huge returns, but because cash creates psychological stability. People panic most when they feel trapped financially. Cash reserves give investors options. One Reddit discussion during market volatility emphasized that having cash during panic periods creates opportunities instead of fear. This changes investor psychology completely. Instead of, "I'm doomed," the mindset becomes, "Everything is on sale." Commodities, energy, and real estate. These assets often perform better during inflationary environments compared to traditional stock-bond portfolios. This is why experienced investors often focus on businesses with strong cash flow, low debt, durable demand, and long-term profitability. Not hype, not trends, not fantasy. But quality businesses tend to recover because real businesses continue generating value even during chaos. And this leads to the most important truth in investing. Market crashes are normal. They are not rare accidents. They are part of the system. Fear and greed move in cycles. One market report highlighting Bob Farrell's famous investing rules explained that excess optimism always creates corrections eventually. And honestly, that may be the entire game. Because investing is less about intelligence than emotional control. Anyone can buy assets during easy markets. Very few people stay calm during chaos. That is what separates investors from gamblers. And there is something even more important most people never realize. Market crashes are where long-term wealth is often created, not because crashes feel good, but because fear creates opportunity. Extreme greed during bubbles, and extreme fear during crashes. The smartest investors understand both. And there is one final truth nobody tells ordinary people during market panic. The goal is not to predict every crash. The goal is to survive them. Because if your strategy only works during easy markets, it is not really a strategy at all.